Why Japan's rising interest rates are shaking the global financial market. Japan has long been a unique case in global finance, with borrowing costs nearly zero for almost 30 years, hovering around the 0.1% mark. This ultra-low rate gave rise to a significant financial strategy known as the yen carry trade. The yen carry trade involved borrowing money cheaply in Japan and investing it in higher yielding markets like the US bonds, where you can get around 4% rate, US stocks about 8%, or emerging market bonds where you can get around 6 to 8%. Despite costs like currency conversion and hedging risk, this was still a profitable trade for many investors and institutions worldwide. However, as of November 2025, Japan's borrowing costs have surged towards 2.8%. This jump is significant because Japan's government debt stands at approximately 250% of its GDP, one of the highest debt to GDP ratios globally. If rates continue rising, Japan risks facing serious difficulties in servicing its massive debt, raising alarms among global investors. The sudden increase means many profits made through the yen carry trade are evaporating, forcing investors to reconsider their positions, even possibly selling the US assets to cover higher borrowing costs. The key driver behind Japan's rate hike is a marked shift in the inflation landscape. For the first time in about 25 years, Japan's inflation rate has breached 3%, well above the Bank of Japan's long-standing 2% target. Despite inflation rising, real wages have seen minimal increase, creating pressure on monetary authorities to tighten policy by raising interest rates. This strategy aims to temper borrowing and slow inflation. The Bank of Japan initially nudged rates from about 0.1% to 0.25% in August 2024, prompting notable market volatility. The recent hike to nearly 2.8% is the highest since the early 1990s, marking the end of a decades-long era of ultra-loose monetary policy. The yen has depreciated sharply, hitting 10 months low against the dollar. Now, for investors, this kind of environment demands caution. The days of easy carry trades may be over, and capital preservation should be prioritized over aggressive growth strategies.